Hello and welcome. Mortgage rates are the most powerful and the highest impact indicator on house pricing today. So in this video, we'll discuss in detail with some data and facts to figure out what impact could rising interest rates have on the housing market and why it should concern you. Whether you're buying a house, you own credit cards, you have a line of credit, interest rates affects all of us. So if that interests you, stick around to find out more. Hola, ¿cómo estás? Konnichiwa, ni hao, salam, namaste, kef halik, privet to all my friends all over the world. I'm your host, AK. I'm an investor. I'm an entrepreneur. I have a master's of science in computer science. I have worked for top 3 consulting firms in the world. I do development, I do buildings, I do flips and rehabs. I have rental properties, and most importantly, I provide affordable housing for the needy. And that is my goal, folks. This channel is for the outsider, outsiders like yourself and outsiders like myself. So in this video, we're gonna have some fun. We're gonna view some TikTok videos of some fake gurus who are posing to be a real estate expert, but they have no idea what real estate is about. They have no knowledge of real estate, yet they're talking about they have all these properties and values. So just for kicks, we're gonna do that, okay? So stick around till the end to watch that. Now, if you have a 30-year loan, I mean, you're okay. You don't have to worry about interest rates. But if you have a variable rate, which is called the 5-1 ARM, then I think you have to really worry about it, because folks, with 5-1 ARM, your rates can go up and down anytime depending on the market. And that can be very detrimental to your savings and to your future plans. Why? Because a variable rate could also mean a variable payment. That means you don't know exactly how much you're paying month to month. So that can offset your budget and your balance. So be very careful about that. Also, if you have credit cards, you have to worry about interest rates, because credit cards also have variable interest rates. Historically, when companies have increased credit card rates, it's due to the rates, overall rates increase, because they want to squeeze as much juice out of your credit cards as possible. So, and they want to take up your savings. So when that happens, you know that the rates are rising and your credit card rates will also increase because of that. Now, if you have a line of credit, taking some loan out to buy some furniture or add some value to your life or pay off some student loans, it's very dangerous, because when the interest rates rise, those payments, those checks that you're writing every month could also change drastically, folks. So please understand that the rates have massive ramifications, and I don't want to scare you or anything, but if the rates go up in a few percent, it doesn't really matter. Let's say if the rates go up from 2.9% to 3.25% on a $200,000 loan, well, your payments will only change like $60 a month. So it's not the end of the world. But if the same rate goes up to 4.5%, well, then you have a $160 difference approximately. So your monthly payments can get out of your hands if the rates keep increasing. So you have to be very sure and careful that you keep an eye on rates. Also, as a home buyer, you want to make sure you keep looking at the rates, because the rates do affect the market. Sometimes they don't affect the market because there are other variables such as inflation and demand and maybe pandemic and so on and so forth, but that's a separate factor. You still want to watch the rates to see, when can you jump if the rates are affecting the house prices. So why are the rates increasing is the question, right? Why are the Feds adamant about increasing interest rates? There's a reason for that. They want to slow down this inflation. They want to make sure that the prices of houses do not keep going so high that nobody can buy those houses. And right now, it just seems like it's headed that way, folks, because the overall indicators are that the market is strong. It's just going to keep going high and high. If that happens, then it's going to be out of reach for most people, for an average Joe or Jen. When interest rates increase, what also happens, the stock market gets affected, okay? And I'll tell you why. Stock market actually takes a hit from that, because the value of the bond goes lower. If you want to learn about bonds, you can Google the fact and how bonds work and so on and so forth. There's some really nice videos. And these bonds are issued as assets to companies and to investors. So it has an adverse effect on the companies. They will stop hiring, start firing people, because their bond are not giving them as much return. And usually a market goes through a correction when interest rates keep rising. So I want to bring that to your attention so you're aware of that, how rates are so important beyond just housing, beyond HELOC, beyond your credit cards, beyond your purchasing, and beyond your mortgage rate. It also affects the whole world, including the stock market, okay? And the bond market for that matter. So let's look at a couple of markets, because people have been asking me, dropping questions. There have been some trolls who are saying, well, nothing is going down. Well, I want to present some facts to you folks. This is not information that I just cooked up from my own, okay? In my previous video where I show you guys there's no crash, I also show you some of the graphs and charts. But here's my message to you folks, that There are a couple of markets, okay, and there's more than that. I'm sure there's more than that. One I know personally, okay. There are a couple of markets such as, let's look at Dallas market. Dallas has only gone up 1 or 2% in the past few years. So why is that, right? Why is Dallas not exploding like the entire other US? Well, they have a lot more land, okay? And there are other factors involved. So you have to look at not just the state level, you have to look at the city level, okay? They're leveling off, folks, and that's happening in a lot of places, including Las Vegas. Las Vegas also has a similar trend where the prices just shot up like a rocket and then they level off. And you need to be aware of those. For those of you naysayers who think that the market is not slowing down in other places, you're wrong. You have to look at the facts city by city, state by state, and sometimes even by the county level. Let me give you a solid example of a recent market here. My own sister is selling a house, okay, in Rockville, Maryland. Well, guess what happened? In Rockville, there's a small town called Durwood, Maryland. In Durwood, only 10 houses sold in the last month. But guess what? The house prices are less than 20% from last year. So you would think that everything in Rockville, and Rockville is a great town, folks, a great city. Prices are fluctuating differently and going at a different rate in Dallas versus Durwood of Maryland. So please understand that. And if you have any confusion, drop me a comment or a question, I can clarify that. By the way, if you love the content, if you love what I'm sharing the knowledge with you and helping you guys out, please drop a comment and a like and show some love for your boy AK. Thank you so much for that. So what happens if the interest rates keep going up? Right now they're at 3.11 for 30-year, okay? What if they keep going up? Well, the graph of the house price increase could flatten out, okay? It may just be straight for a few months and it may start to go down. Who knows? We don't know. We're just speculating, not predicting, okay? And the only factor that's keeping the prices high in the other markets, folks, is number one, demand, obviously, and number two, inflation. If those two factors were not there, I guarantee you this interest rate increase will bring the prices down. Again, you have to follow these trends and think like an investor, folks. I want you to think like an investor. You know, don't just look at the rates, okay? Look at the median sale price of your region, of your city, of your state. Look at inflation in your city, in your town. Look at number of foreclosures, okay? Look at the number of days a house sits in the market. Those are the factors you have to look at to answer these questions. So the reason I'm telling you all this is there's a great opportunity, folks. If the rates are going down in your city or state or your town, and you know the inflation is under control, and you see that houses are sitting a little bit longer in the market, that's when you know is an opportunity for you to make a deal, because that makes the seller nervous, right? The sellers get nervous when the house sits for too long in the market, and that's when you can jump in and capitalize on the opportunity. And that's why I'm talking about this whole shenanigan about real estate and interest rates, because they are directly or indirectly connected to each other, okay? So you might say, AK, so what about interest rates and refinancing? How does it affect that, folks? Interest rates have a huge effect on refinancing. Refinancing has gone down 20% from last year, and it continues to go down. The number of people who are refinancing are not refinancing as much because some people already have a good rate for the past few years, right? So why would you refinance, spend several $1,000s? In general, the market is not as healthy, folks, and I say that from the affordability perspective, right? The prices are out of reach, you know. A townhome in Canada is selling for $1 million, right? I mean, that's insanity. So I think, you know, as a subsequent effect of that, a lot of parents are giving gifts and keeping their kids in their own house until they are able to buy a house so they can save more money. And that's a bit of a bummer, right? Because even though you have a good job and a good savings, you can't afford a house because houses that you want are $500, $600, $1 million. When prices go for houses, 14% increase, right, or whatever, you have to also factor in inflation. When prices for houses go up, let's say 14%, let's say in Virginia or Maryland, it doesn't mean it's actually 14% because you have to subtract the inflation rate, folks. Inflation is 5 or 6% right now. So if you deduct that from the price of the house has actually only gone up 10%. It may be a bubble in some states and cities where it's like 20%, 30%. But if the house price has gone up 10% for a single family home, that's not out of the norm, folks. Okay, that happens, okay? There are other factors here, demand and supply, as we talked about in the other videos. Always subtract the amount of inflation, just like you subtract the amount of inflation from your salary. If you get a 3% raise, but inflation is 6%, did you really get a raise? No, you didn't. No, you didn't. Be honest with yourself, okay? You did not get a raise. A very important point that nobody's talking about. So how do interest rates affect the banks? Well, the banks can charge you more money. they can make more money, they can make their investors happy. That's why they also would promote and enjoy interest rates, right? The Bank of Nova Scotia also said that they will try to increase interest rates 3 or 4 times next year in 2022. So why are they increasing the rates? Because they want to have more returns. They know there are more buyers in the market and the house prices are higher, the loans are larger. So if they increase the interest rate, boom, they can make more money. So banks are in this, folks. Banks want the rates to go higher and go up and up and up. What is also playing a factor here is that the US dollar is devalued, folks. Why? What it used to buy for $100, a few years ago, it cannot buy the same amount of money or assets for that $100 anymore. And that's what I mean by inflation, is that the dollar is weaker. So you have to pay $1 million for a townhome to be able to afford that 1,800, 2,000 square feet of house. The same price that was being sold for 500 a few years ago. And this is all because of quantitative easing, which is a concept that was introduced back in Obama's days in 2008. When the crash happened, they pumped a lot of money in the market, bailed out these banks who were lending money illegally and unethical ways and manners, and that's what happened back then. So quantitative easing is happening again in this market. Government is printing money is being pumped in the market. The Feds are buying mortgage-backed securities to create a perception that the market is healthy and it should keep growing. So let's look at the graph and chart that I want to show you guys on the screen here. If you look at the ARM, 5-1 ARM, which is 2.49%, the 30-year fixed is 3.11%. In this chart you see, so the 5-1 ARM is actually going down right now, while the blue line is going up. Now let's zoom out a little bit, right? Let's look at December, right? December of last year. Wow. Let's look at this. See what happened here, folks? There was a spike in the ARM rate, right? 2.4% went to 3.5% or 3.12%. Wow. And then what happened to the 30-year interest rate? 30-year interest rate also got up to 2.79%. So what does that tell you? That tells you that the rates go up and they affect each other. They kind of play off each other. So when the ARM went up, 30-year also went up. But guess what happens then? If you have a home equity line of credit, that ARM means your payment just went up $100 more per month, depending on you pulled out $10,000 or $20,000 or $100,000 from your house. Now let's look at another chart from the past 28 months to see how the rates are fluctuating in the past 28 months to get a bigger picture of the history of rates, right? So want to understand what has been happening all this time, right? So rates were like 4%. So rates were 4%, around 2019, right? And then from 2019, they started coming down, because of COVID, because of other factors, because of supply chain. They kept coming down. But now if you see in the past, 6 or 7 months, they're sort of going up now. And that's really interesting, right? They're sort of going up. Now, I want to bring another chart to your attention. If you look at this chart in front of you, the 30-year fixed was pretty high, 1990s. But these gray lines you're seeing, folks, in the middle, these gray lines are actually the recession times. And that's why a lot of people are saying the market will crash and so on and so forth, because we haven't had that recession since 2008. So let's look at the last 3 or 4 recessions, right? So around 1998 or 1990s, right, 1993, I think, to be exact, there was a recession, the dot-com bubble burst. Then again, around 2000 or so, there was recessionary factors that occurred. Then now the 2008 recession that also occurred quite recently, was the last big recession where Fannie Mae and Freddie Mac were audited for lending, loans, unethical practices, and so on and so forth. So that's very important, folks. So you know that the last recession happened already in 2008. So now that's why a lot of people like Robert Kiyosaki, and they're predicting like, oh my God, there's going to be another recession because the market is inflated. It's been healthy for so long. Inflation has been low in the US for the most part, but inflation in other countries is pretty high. Like, for example, Argentina is over 13% inflation. So my point is this, right? That look at these recession factors, look at these rates, how they are going down, and now they're kind of sort of going up. So I won't be surprised, and again, speculating that I won't be surprised in the next 3 to 4 to 6 months, you might see rates as high as 4%. Okay. Now, if that happens and inflation is under control, then do expect to see the house prices adjust and correct themselves. Okay. When I say correction, I don't mean that, oh my God, it's going to go 50% down. No. There will be corrections again, city by city, state by state, town by town. Somewhere it might be 20%, somewhere it might be 10%, some places it might be 5%. Who knows, right? We're just speculating based on this data. And the data tells a story, right? Look at the story, the graphs going down and then going up. And that's beautiful. So with that, I'll recap, folks, that rates are a critical factor, and I want you to educate yourself in how rates affect the housing market, the bond market, the stock market, the credit card, the home equity line of credit that you have taken. If your house mortgage is an ARM, is an unfixed rate, it's not a fixed rate, it's going to affect those people the most. So those people have to really worry and make sure they don't get shortchanged by this rate increase. Okay. Now let's look at the fun part, the TikTok videos, okay? See what these clowns are doing so we can have some fun at their expense, right? Yeah, so let's look at this lady. She's dancing. She's saying when you realize you can get your real estate license for $300 and start selling $1 million homes, right? This is too funny, folks. You're going to get your real estate license for $300 and start selling $1 million homes. Who the hell is going to give you $1 million home to sell when you just got your real estate license? So that's a fake guru right there for you guys. Okay, so this lady seems like at first she thought real estate was a joke, but now she's showing that she has received, but bro, wow, I got a big check, and the check is about, I don't know, $20,000 or $28,000 or something. Now, this person seems like a wholesaler or a realtor who just got lucky with a big check and now telling the whole world, look, I got this check, which is a small check, by the way, but nonetheless, another fake guru trying to claim that I have a channel. But here's this funny guy, right? Look at this guy, okay? A wonderful $10 shades and a $4 cup of coffee, the mask hanging all over the place. He looks like someone who does airport cleaning because he's always sitting at some station. Claims that he owns 3 self-storages. Wow. How do you do that when you don't even have money to buy a decent watch or a pair of pants without any of your own money? Yeah. Well, and this guy never talks. He never tells you how much knowledge he has. He just talks about, he just posts these, these texts and images that talks about how many properties he owns, how many warehouses he owns, and he has thousands of followers. People are just claiming to be, King Kong when they don't know. They don't actively do real estate, but they just read up online and they gather all these things. They're trying to fool these 20-year-olds, but you know what you're getting here. You're getting solid information from someone who's actively on the ground, building the properties, working with contractors, who understands what real estate is in and out. And if you guys have any questions on construction, rehabbing, burst strategy, fix and flips or rehabs, whatever, ask me questions. I'll be happy to point you in the right direction. If you have any questions around the county, how to work with the county or historical districts, where I'm doing 2 buildings recently in Baltimore, any questions like that, I'd be happy to help you guys. So with that, I want to thank you for joining us for another good video. Again, if you have any questions, somebody dropped a comment about Portland, so I apologize, but I didn't get a chance to look into it. I will look into Portland, Oregon, and get back to you and show you the market analysis of that. Folks, the data, some of you have asked where I pulled my data from. I get investor report for zip codes, for local zip codes, okay? That's a separate report. But for you guys, what I do is I go to Zillow, I go to Realtor.com, I go to Fred.com, I go to Redfin.com, and I try to look at all those data and trends. And then I come and derive a conclusion and try to pull whatever the simplest graph and chart that I could find to show you guys what the market would look like. Because anybody can look at the data, right? But investors also have insight, because I have seen markets go up and down. I've been through these ups and downs in the market. I know exactly what's happening. And what I'm telling you is real. You can look it up, you can research yourself. Don't just listen to these burning houses, images and icons, and these people are scaring you. Recession's coming, this is coming, crash is coming. They don't know. If they knew that, they won't be YouTubers, If you see anybody making 3-4 videos a week, they are full-time YouTuber, folks. They're not investors. Investors don't have that kind of time to make 10 videos a week. We don't. I'd be lucky if I can put out 2 videos a week, because it takes time to research. And you guys are asking smart questions, so I have to think before I say something, because you guys are gonna catch me, right? So I have to be very careful with you guys, because some of you are very smart cats out there. So no, but I'm kidding. I love it. I enjoy it. I appreciate you guys. Again, this channel is for the outsiders, so I appreciate you guys. I gotta go feed my dog now. I want to thank you again for joining my channel. And I love you all, and I'll see you in the next video. Bye now.